Welcome to the high-stakes world of trading. Beneath the surface of complex algorithms and high-frequency trading lies a fundamental truth. Trading is about human decisions, driven by ambition, fear, and the allure of profit. Fortunes are made and lost in the blink of an eye, where calculated risks can yield unimaginable rewards, and miscalculations can lead to catastrophic consequences. Our journey takes us into the heart of this dynamic world, exploring captivating stories of trading gone wrong, tales of ambition, risk, and financial misjudgment. From energy markets to metals, each case study offers a unique glimpse into the human drama that unfolds when ambition collides with market realities. Through these experiences, we gain invaluable insights into risk management, the perils of excessive leverage, and the dangers of speculation. Why revisit the mistakes of the past? The answer lies in the profound lessons we can glean from these trading disasters. By understanding the factors that contributed to these catastrophic events, we gain a deeper appreciation for the complexities of the market and the importance of sound trading practices. Each trading disaster we'll explore offers unique lessons, highlighting different pitfalls and emphasizing the importance of various risk management strategies. From the Amaranth Advisors debacle to the Sumitomo Corporation's copper catastrophe, each case study provides valuable insights into the potential consequences of unchecked ambition and the importance of ethical trading practices. By understanding the human element at play in these high-pressure situations, we gain a more nuanced perspective on the challenges of risk management and the importance of emotional intelligence in navigating the financial markets. By learning from the mistakes of others, we can strive to make more informed decisions, manage risk effectively, and navigate the world of trading with greater awareness. In the realm of high finance, hedge funds often operate with an air of mystique, their strategies shrouded in secrecy, and their bets fueled by ambition and risk tolerance. Amaranth Advisors, a multi-billion-dollar hedge fund, quickly gained a reputation for its aggressive trading style and substantial returns, particularly in the energy markets. At the helm was Brian Hunter, a young trader with a reputation for making bold bets on natural gas futures. Hunter's strategy centered on exploiting price discrepancies in natural gas futures contracts, betting on his ability to predict future price movements with greater accuracy than the market. The allure of natural gas lay in its volatility, with prices fluctuating wildly based on factors like weather patterns and economic growth. Hunter believed he had identified a pattern in these fluctuations, allowing him to predict future price movements with remarkable accuracy. As Hunter's bets grew larger, so did Amaranth's profits, attracting significant attention from investors. However, the seeds of a catastrophic downfall were being sown in the very strategies that had brought Amaranth such success. As 2006 unfolded, Brian Hunter and Amaranth Advisors were riding high with $9 billion in assets under management. Hunter's strategy relied heavily on exploiting price differentials between natural gas futures contracts, generating impressive returns. Hunter made a massive bet that natural gas prices would surge during the winter of 2006 to 2007, anticipating a repeat of the previous year's cold snap. However, the winter turned out to be unusually mild, leading to a significant drop in demand for heating fuel and sending natural gas prices tumbling. Hunter's massive long position rapidly transformed into a catastrophic liability, eroding Amaranth's capital base. As natural gas prices continued their downward spiral, Hunter found himself trapped in a margin call squeeze, struggling to post additional collateral to cover his losses. The once liquid natural gas market had dried up, and there were few buyers willing to take on Hunter's massive positions. Amaranth's losses mounted with each passing day, and the once mighty hedge fund was now teetering on the brink of collapse. The downfall of Amaranth Advisors stands as a stark reminder of the double-edged sword of leverage in financial markets. While leverage can amplify gains, it can also magnify losses to catastrophic levels, as Brian Hunter and Amaranth's investors learned the hard way. Investigations revealed a series of missteps and oversights that contributed to the disaster, providing valuable lessons for traders, investors, and regulators alike. One of the most glaring takeaways is the importance of robust risk management practices. Hunter's strategy lacked sufficient safeguards to protect against a major market reversal, and there were inadequate systems in place to mitigate the risks associated with his concentrated bets. The Amaranth saga also highlighted the importance of regulatory oversight in mitigating systemic risk, leading to reforms aimed at enhancing transparency and oversight of hedge fund activities. The goal was to prevent future Amaranth-like events from destabilizing the financial system and to ensure that taxpayers would not be left footing the bill for excessive risk-taking. In the bustling trading floors of Tokyo, one name commanded both fear and respect: Yasuo Hamanaka, known as Mr. Copper. As the chief copper trader for Sumitomo Corporation, Hamanaka held sway over a market that touched countless industries. Hamanaka's rise to prominence was as remarkable as it was controversial, quickly ascending the ranks of Sumitomo and demonstrating a keen understanding of the copper market. His trading strategy was both audacious and highly effective, believing he could control the price of copper through massive trades and strategic market manipulation. Hamanaka would accumulate huge long positions in copper futures contracts, driving up prices and creating an illusion of scarcity. As prices rose, he would then secretly sell off portions of his holdings, reaping enormous profits for Sumitomo. For years, Hamanaka's strategy worked flawlessly, generating consistent profits and cementing his reputation as Mr. Copper. However, unbeknownst to Sumitomo's executives and the global copper market, Hamanaka's empire was built on a foundation of deceit. As the mid-1990s approached, cracks began to appear in Hamanaka's carefully constructed copper empire. The global economy was in a state of flux, and copper prices began to soften. Hamanaka, confident in his ability to control the market, doubled down on his bets, accumulating even larger long positions in copper futures contracts. However, copper prices continued their downward slide, and rumors began to circulate about the true extent of Hamanaka's positions. The market, sensing blood in the water, began to turn against Hamanaka, and his massive long positions evaporated in value. Hamanaka found himself trapped in a margin call squeeze, struggling to unwind his positions before the full extent of his losses became public knowledge. Sumitomo's losses mounted, and the company's executives were faced with the horrifying reality of Hamanaka's actions. The once venerable trading house was teetering on the brink of collapse, its fate hanging precariously on the ability of its executives to contain the fallout from Hamanaka's reckless gamble. The Sumitomo copper scandal sent shockwaves through the global financial system. A single trader's manipulation raised serious questions about risk management and regulatory oversight. The scandal highlighted the importance of transparency and ethical conduct in markets. Sumitomo Corporation took swift action to address the failings. They implemented reforms to strengthen internal controls and compliance. Sumitomo cooperated with regulators to restore its reputation. The scandal led to broader industry reforms and stricter trading rules. The goal was to prevent future market manipulation. The scandal served as a wake-up call for the financial industry. The lessons from Sumitomo's catastrophe remind us that profit must not come at the expense of integrity. The Hunt brothers' attempt to corner the silver market is a tale of ambition, risk, and the allure of wealth. Nelson and William Herbert Hunt, heirs to an oil fortune, were drawn to commodities trading. Fascinated by silver, they saw it as a strategic asset with potential for price appreciation. They aimed to control the silver market, acquiring enough to dictate its price. Their strategy was to create a silver shortage, driving up prices. But cornering the market was risky, with regulatory hurdles and market forces. As the Hunt brothers' silver holdings swelled, silver prices began a steady ascent. Their buying spree created an illusion of scarcity, sending market participants scrambling. Speculators piled into the silver market, further fueling the price surge. Silver became the talk of the town, its price plastered across newspapers and TV screens. The Hunt brothers' wealth skyrocketed, their name synonymous with market manipulation. However, the silver market was a bubble on the verge of bursting. The consequences of its implosion would be swift and devastating. The Hunt brothers' reign over the silver market proved to be as short-lived as it was spectacular. As silver prices soared, market forces began to assert themselves. On March 27, 1980, the bubble burst. Silver prices plummeted by over 50% in a single day. The Hunt's leveraged positions triggered margin calls, threatening their fortune. The collapse sent shockwaves through the global financial system. The brothers were vilified as reckless speculators. They were forced to liquidate their assets at fire sale prices. The Silver Thursday debacle marked the end of an era for swashbuckling speculators. In the annals of financial disasters, the name Metallgesellschaft, or MG, stands as a stark reminder of the perils of complex derivatives trading. Founded in 1881, MG was a German industrial conglomerate with a long history in mining, metals production, and engineering. In the early 1990s, MG embarked on a fateful foray into oil futures trading, a decision that would bring the company to its knees. MG's foray was driven by a desire to diversify its revenue streams and capitalize on an undervalued oil market. The company established a subsidiary in the US, MG Refining and Marketing, or MGRM, to manage its energy trading operations. MGRM, led by ambitious traders, devised a strategy known as stack hedging to profit from their bullish outlook on oil prices. The strategy involved taking long positions in short-term oil futures contracts while selling long-term futures contracts. However, the strategy relied on the assumption that oil prices would remain stable or rise, which proved fatally flawed. As 1993 unfolded, MGRM's stack hedging strategy began to unravel. Oil prices fell sharply due to increased OPEC production and a mild winter. The market volatility exposed a fatal flaw in their strategy. MGRM faced a cascade of margin calls, draining its cash reserves. Their long-term futures contracts failed to provide the expected protection. The situation spiraled out of control, threatening MG. News of massive trading losses sent shockwaves through the business community. MG's stock price plummeted, and its credit rating was downgraded. MG's management took drastic measures, replacing the MGRM team. They began unwinding the company's massive oil futures positions. MG suffered losses estimated at over $1.3 billion. The aftermath and the enduring lessons of Metallgesellschaft. The Metallgesellschaft fiasco sent shockwaves through the financial world, highlighting the risks of complex derivatives trading. It prompted calls for greater transparency and oversight of derivatives markets. MG faced a long road to recovery, selling assets and laying off employees. The debacle provided valuable lessons for companies and investors. It underscored the need for robust risk management systems. Clear lines of responsibility and accountability are crucial. The scandal serves as a cautionary tale about unchecked risk-taking. Section 1. Fueling ambitions. China aviation oil's rise and the allure of derivatives trading. In the early 2000s, China's economy was booming, driven by a huge demand for energy. China Aviation Oil, or CAO, rose with the aviation sector, securing jet fuel supplies. Based in Singapore, CAO thrived, its profits soaring with China's air travel industry. As CAO's trading volumes grew, so did its appetite for risk. Eager to maximize profits, CAO ventured into derivatives trading. Derivatives offered potential gains but carried significant risks. Chen Julin, a charismatic executive, led CAO's derivatives trading. Chen saw derivatives as a way to leverage CAO's market position. He assembled a team of young traders encouraging aggressive market positions. Initial success led to Chen gaining more autonomy, but Chen's speculative activity set the stage for a trading disaster. The stage was set for one of the most spectacular trading disasters in Asian corporate history. Section 2. A high-risk gamble. Chen Julin's speculative bets and the perils of unchecked authority. Emboldened by early successes, Chen Julin took risky positions in the derivatives market. He bet heavily on rising oil prices, using options contracts to amplify gains. But options carry the potential for unlimited losses. Chen believed oil prices would rise indefinitely. He dismissed his risk management team's warnings. Convinced of his infallibility, he ignored cautions. In late 2004, oil prices began to decline sharply. Chen faced mounting losses. Desperate, he doubled down, increasing his exposure. His actions only exacerbated the losses. The trading operation was now hemorrhaging cash. Section 3. The crash and its aftermath. Unraveling the losses, seeking accountability, and rebuilding trust. The news of CAO's massive trading losses sent shockwaves through Singapore and beyond. The company, once a symbol of China's economic might, was now facing financial ruin. The Singapore government launched an investigation, uncovering reckless speculation and inadequate risk management. Chen Julin was arrested and charged with insider trading. He was convicted and sentenced to 4 years in prison. CAO faced a long process of restructuring and rebuilding trust. The scandal served as a wake-up call for regulators and corporate boards. It highlighted the importance of robust risk management and transparency. It underscored the need for greater vigilance in monitoring executives. The scandal prompted reforms in China's state-owned enterprises. It served as a cautionary tale about the risks of rapid growth. The lessons from CAO's downfall remind us of the importance of ethical conduct. Reflecting on the common threads of trading disasters. From Amaranth advisors to China aviation oil, a common thread emerges: ambition, risk-taking, and market miscalculation. These stories reveal timeless pitfalls in global finance. Leverage, while powerful, can become a weapon of financial self-destruction. Excessive use of borrowed funds turned manageable setbacks into catastrophic losses. Leverage requires a skilled hand and awareness of its dangers. These disasters expose the fragility of human judgment. Yasuo Hamanaka, the Copper King, found himself at the market's mercy. His downfall highlights the dangers of unchecked authority and invincibility. These stories offer invaluable lessons for navigating trading. Markets are unpredictable, and risk management is fundamental. The human element, the perils of hubris, groupthink, and the illusion of control. Financial markets are more human than they seem. Greed, fear, and hubris can cloud judgment, leading even seasoned professionals astray. Success can erode risk aversion, leading to dangerous overconfidence. Groupthink silences dissent, pushing shared optimism and conformity. The Metallgesellschaft fiasco shows how groupthink can override risk management. The illusion of control in finance is often fleeting and deceptive. The Hunt brothers' downfall in the silver market is a stark reminder of this illusion. Section 3. Navigating the future of finance. Embracing risk awareness, ethical conduct, and continuous learning. In the wake of trading disasters, the temptation to demonize risk is understandable. Yet, risk-taking drives innovation, progress, and economic growth. Lessons from these tales guide us towards a nuanced approach to finance. Embrace risk awareness in financial decision-making, commit to ethical conduct as a cornerstone of financial activity. Continuous learning is essential in the ever-changing financial landscape. By fostering risk awareness, ethical conduct, and continuous learning, we can create a resilient financial future.